If you've been managing your crypto portfolio and have been watching other investors capture serious gains while you're stuck making pennies on the dollar, this video explains why that happens and what successful crypto investors do differently. Remember that Bitcoin gained 136% in 2024, but according to CoinLedger's study of 500,000 investors, the average person made just $5,482. In 2023, again, Bitcoin more than doubled in price, but again, the average investor made only $887. In both of those years, sophisticated, good crypto investors were capturing life-changing returns. And they were doing this through assets like Aerodrome, which gained 3,000%, Mantra, 8,776%, Virtuals, 23,000%. That type of return turns $50,000 into $11.5 million. Now, I know you would fire any fund manager who underperformed the market with your money by over 90%. So my question always is, why are you running your own crypto portfolio without any help, especially when specialized help exists for this market? I'm Frank Hepworth. I run a company called Yield School. We are a non-custodial crypto consultancy that works with over 1,500 high net worth investors. My 2021 thesis multiplied my crypto portfolio by 11x, and as a former regulatory attorney, I helped launch some of the very first crypto ETFs on the Toronto Stock Exchange. And as someone who has worked on token launches and venture capital transactions in crypto, I can tell you without a doubt, the crypto market rewards specialized knowledge in ways that traditional markets do not anymore. The problem that we see is that most investors try to navigate the crypto market using frameworks brought over from traditional finance. This video covers 3 fundamental problems that reduce crypto portfolio performance and explains why crypto native consultants can solve each one systematically. First, most crypto investors get destroyed by volatility because they don't understand how bull markets actually unfold in this space. In 2012, Bitcoin traded at $5. 1 year later, it was $1,000. That's a 200x gain in 12 months. In 2016, Bitcoin hit $300. A year later, $17,000. In 2020, Bitcoin touched $5,000. By 2021, $65,000. Now, these moves happen much faster than what happens in traditional markets, and they don't happen in straight lines. Bull runs include multiple 20%, 50%, and sometimes even 80% corrections along the way. And most investors just panic sell during these corrections, then watch as prices go to all-time new highs. We track wallet behavior during the market cycles, and what we see is that retail investors consistently sell the bottoms and buy the tops. They lack the tools to manage the volatility, and the behavioral psychology behind this is that once you own a crypto asset, the endowment effect makes you value it 2.5 times higher than the comparable asset that you're not holding. So your loss aversion means selling at a profit feels like losing future gains. And so you're going to hold onto a winning position too long and then ride it back down. And what we've observed with good, sophisticated crypto investors is that they actually use predetermined profit-taking rules that just reduce the emotion. For example, when a position hits a 2x gain, they sell 25%. At 3x, another 25%. At 5x, another 25%. This locks in much of a 5x return while keeping 25% for potentially bigger moves in the future. Good crypto investors understand that corrections in these markets are a feature of the market and not a bug. Now, crypto native consultants can come in and provide a customized action plan that takes clients maybe 90 minutes a week to execute. These plans eliminate the emotional burden that comes with profit taking, and fundamentally, plans like these prevent self-sabotage. And the key insight here is that 95% of crypto investors lose money due to poor exit timing, not poor entry timing. Crypto volatility isn't random. It follows patterns that can be managed with frameworks and discipline, but volatility management is only the first challenge. The second is even more overwhelming because 5,300 new tokens launch every single day across all on-chain networks combined. That is one new token getting launched every 16 seconds to add to the roughly 36 million that already exist. And 99% of these things are junk. And so the question is, how do you reliably identify the 1% worth looking at from the 99% that are just going to drain your capital? The traditional financial analysis methods don't prepare you for this challenge. A quick filtering framework that I would suggest would be to first, only consider protocols with over a $50 million market cap. That eliminates 99.8% of tokens immediately. Second, require the protocol's development team to be doxxed and to have previous experience at some other tier 1 or tier 2 protocol. And third, require that the protocol have a mechanism that drives value back to the crypto asset itself. If you were to use those 3 filters, that's going to narrow down the 36 million tokens out there to maybe 150 projects worth deeper analysis. then you could use what I call a 55-15s allocation. That's 55% in the core large caps like Bitcoin, Ethereum, and arguably Solana, and then 15% in each of, number one, the mid-cap innovators of the current cycle. So for this cycle, that would be Athena, Morpho, assets like that. Another 15% in yield-bearing protocols that generate passive income on cash. And finally, the last 15% in the early stage projects that pass the filtering system, like the one I just suggested, from above. Now, all of that isn't coming from a traditional financial market company. That is coming from a crypto native specialist. For the traditional markets, if you wanted help investing in those markets, you already have established options. You've got Fidelity, Morgan Stanley, Charles Schwab, Vanguard. These guys are providing research, analysis, and portfolio management using frameworks that have been built from decades of experience. But crypto is different. There are no spoon-fed solutions like a Bloomberg terminal or a nice gap audited financials. Even the traditional wealth advisors that are operating in the traditional markets, they can't really help you either, because the license that lets them give financial advice legally also restricts them from servicing unregulated financial assets, and crypto falls into that category. And even if the traditional guys could help, they still lack the specialized knowledge. Traditional analysts and advisors, honestly, they're just kind of old because they've spent 20 plus years working their way up a totem pole in a big wealth management firm so as to be able to serve an existing book of clients. They have mastered the traditional markets and know all the established frameworks for analyzing regulated companies that file quarterly reports and follow standardized accounting practices. But crypto protocols don't file 10K reports. They don't have GAAP accounting standards. They operate as decentralized software systems that are fundamentally new business models. So analyzing a DeFi lending protocol like Morpho requires tracking and understanding its TVL, measuring borrowing demand across the different on-chain networks, understanding how its interest rate mechanics work, and then comparing its lending protocol capital efficiency against the other competing lending protocols on the same and other on-chain networks. And each of those data points exists, but there is no single platform that aggregates them into a standardized analysis. There is no Bloomberg terminal for crypto. Crypto analysis, to make sense of what I just said for Morpho, it happens on Dune Analytics, Token Terminal, DeFi Llama, Messari, and a dozen other specialized crypto platforms. Each of those platforms requires a different set of skills and familiarity, and this is why traditional analysts consistently miss crypto opportunities and the returns in the crypto market generally. In May 2021, JP Morgan called Ethereum overpriced, and then 6 months later, its price increased 100%. In April 2024, Goldman Sachs denied crypto as an attractive asset class, and then over the next 18 months, Bitcoin's market cap increased by 1.3 trillion. Unlike traditional financial market advisors, crypto native consultants live in this ecosystem daily. They've developed their own frameworks for filtering signal from noise, identifying compelling projects, and timing entries across the market cycle. And it is this need for on-chain specialization and skills that has actually created the third major problem retail crypto investors face. And that problem is that when one tries to actually get crypto help online, they encounter a wasteland of scammers, influencers, and gurus. These young crypto gurus on Twitter, they're promising 100x returns. Some YouTube influencer is going to sell some token that they've been paid to promote. There's a Telegram group that is promising alpha, but they're just dumping on their followers. Sophisticated scams target crypto investors specifically. There's fake DeFi protocols that drain wallets. There's Ponzi schemes disguising themselves as yield farming opportunities. And see, while the traditional markets have less opportunity and generally underperform for the regular investor, the one benefit of that regulation is that it has brought about consistency. The traditional markets has FDIC insurance, SEC oversight, traceability, and repercussions for fraud. And crypto doesn't have any of that. It operates in a digital, unregulated environment where your security depends entirely on your own knowledge and skills. Every transaction requires you to engage in a smart contract interaction, approve a token permission, and verify a contract address. That is a lot, and a mistake can cost a lot. That's why crypto can be so emotional. There is real danger in the market. For a casual investor, operating in crypto feels like trying to conduct a $500,000 real estate deal by copy pasting some banking information they found in a Reddit thread. It is an emotion inducing process, let alone what's happening with the price. So crypto native consultants come into this experience to add professional systems to that. They provide security protocols, proper custody solutions, and due diligence frameworks that protect capital while capturing opportunity. They can understand which protocols have promise, which teams have track records, and which opportunities are legitimate versus elaborate scams. And it is this specialized knowledge that becomes the foundation for performance. This is why crypto requires specialist knowledge, not because the analysis is less rigorous, but because it analyzes a fundamentally new economic entity using methods traditional analysts have not learned. Wall Street firms are recognizing this gap right now. BlackRock and Fidelity, they have both established dedicated crypto research teams, and they've done it with crypto natives rather than asking their existing equity analysts to come over and try and master crypto. These guys understand that crypto demands specialization. It's like how in the 90s, financial advisors who ignored ETFs fell behind. In the 2020s, investors without crypto native consultants are getting left behind too. As Token Minds explains, crypto consultants today are a blend of tech guru, market analyst, strategist, and regulatory expert, essentially tactical analysts who compress years of trial and error into weeks. Professional crypto investors think about macro-dependent allocations, security, tax optimization, rebalancing, and most importantly, how to combine these elements into a cohesive strategy that captures opportunity while managing risks. The crypto market is becoming the foundation for the next generation of wealth creation, AI protocols, decentralized finance, and really just new economic coordination mechanisms are all being built on-chain as we speak. And understanding this infrastructure early provides the same advantage that understanding the internet provided in 1995. But just like the internet, doing well in understanding that market requires specialized knowledge to navigate effectively. And traditional institutions will eventually catch up. They'll develop frameworks, they'll hire specialists, they'll offer crypto services. But by the time all the big guys are doing that and offering that, the easy opportunities are going to be gone. Crypto native consultants exist today. We understand the technology, we analyze on-chain data, and we position clients ahead of the changes that come with institutional adoption. We're not reacting to it. So here's what I would say today to the casual investor. Just pick your 3 largest crypto positions, set price alerts at 2x, 3x, and 5x from your entry price. And when your assets hit those levels, sell the percentages that I outlined before, 25%, 25%, 25%. And that single simple change will make you outperform 90% of crypto investors who never take profits systematically. And then when it comes to build your portfolio allocations, for the asset filtering to determine which projects are worth your time, start applying that 3-step process I said before. Market cap over 50 million, developers from a previous tier 1 or tier 2 protocol, and then value accrual mechanism built into the asset. That will eliminate 99.8% of projects immediately and protect you from the scams that drain billions of dollars annually. The crypto market rewards preparation, not reaction. And that preparation starts with understanding how to research like a crypto native.